Welcome to What's in Store with Carly and Chris, the show where we cover hot topics at the cross-section of retail and real estate. I'm your host, Carly Iacono, and I'm joined by my co-host, Chris Ressa. Chris, good morning.
Good morning.
How are you?
I'm doing great.
We survived New York ICSC, another one in the books. We're recording this the day after.
That's right.
I'm a little hoarse, but I'm doing my best here, fighting through. Today, we're going to take a few minutes and share our insights from the show. So for everyone who is listening who did not attend New York ICSC or maybe is tangential to the industry, ICSC is an organization for retail trade professionals where brokers and owners and everybody connected to the retail real estate industry comes together for meetings, right? And it's multi-day with events and dinners and so forth. So through the course of this, thousands of people coming together, there's a lot of good insights that come out of it. So we want to take a moment and share our insights and kind of frame where we think the market is and potentially where things are going for 25.
Yes. Yeah. And I think ICSC events are a different type of trade show. I've been to trade shows in other industries. It's not people at booths selling products. It's people going there and what they call deal making, and meetings get scheduled before to try to work on deals, whether that's buying and selling a property, whether that's opening a new store and trying to cut deals. And I think that's a unique trade show event. And in that, people are talking about the state of their respective businesses, what's going on in the market. So the amount of information flow that happens, both empirical and anecdotal, is tremendous. And I always like to take stock of that after the show and analyze that. The entire team puts together our notes of what everyone heard and start to synthesize that. So those are getting aggregated today. I have some of my takeaways, which we'll talk about. I've synthesized my, themes that I heard that were consistent throughout.
It really is a neat mix of new relationships and deepening existing relationships and really going into what clients are seeing in terms of strategy and what they're predicting for 26 as well. So it's good time. It's fast paced, but it really is a great time to get that FaceTime and get more than you can over a phone call.
Have you been to a non-commercial real estate trade show, in a professional setting?
I have. There was a real estate technology trade show that I went to, and it was booths and people selling things and demos and completely different
setup. Yeah.
Actually, I'll tell you, when I started, and I'm sure this was the same for you, when I started going to ICSC a lifetime ago, we would actually bring blank LOIs and have clients who were interested in deals handwrite LOIs at the booth. It was much more of a, here's the inventory, here's your LOI. If you want it, now's the time to make a deal right here and right now. It's been years since it's been done that way. But I think, that is the core deal making back in the day.
Yeah, for sure. I think there's definitely less of that, right? There's a lot of much more analyzing and committees and multiple people involved in decisions that might not be at that meeting. I still think it's super productive. And additionally, the relationship building is, I would say, second to none to be able to do it in person. And the ICSC forges this, scenario where everyone comes to the same city and meets on and gives the opportunity to do that where you otherwise might not have that opportunity.
Exactly. So let's dive into what some of our main takeaways were. And I think, as always, we come at the business from different perspectives, which is interesting, right? I'm meeting primarily with investors and landlords and owners talking about acquisitions and dispositions and stability of their portfolio. And you have some really interesting tenant meetings with expansion plans and overall strategy from the retailer and the leasing side.
Correct.
So we're obviously just the dynamic duo here, the perfect team covering both sides. So we're going to start with one of mine first, and that is everyone asked me, first question, where are cap rates? Where are things trading? Because that is the value in their property, right? Especially in net lease, when the rent schedule is set for so many years, there's not that many levers you can pull to affect value. So cap rates are the main determination of current valuation. So most meetings start with, what are you seeing in the market? Where are the cap rates? And the takeaway now is cap rates are less tied to interest rates than we were expecting, right? We got another rate cut during the show actually this week, which is great, but it's become a non-discussion point where it was, I think in years past, so much more closely tied in terms of cap rates and interest rates. Now the discussion is more, what's the future of the tenant? What is their expansion plan look like? What's their business model look like? How do we price risk in this deal, and not just where is it trading over interest rates? So I'll give you a few examples. Sectors like drugstores and discount stores within net lease have expanding cap rates, even though interest rates are coming down a bit. And that's due to oversupply. There's a ton on the market. There's some murkiness, I guess, about future business strategy and so forth. And investors are pricing those as higher risk deals relative to what they were pricing a few years ago. And because of that, cap rates are pushing out, even though interest rates are coming down. On the flip side, we have things like gas convenience or single tenant grocery where cap rates are compressing because there's tremendous demand and not enough supply. So it again used to be, where are we trading relative to interest rates? And now it's, what does sectors look like and how are investors pricing risk, as opposed to just looking at it as a financing model? How are you seeing that in?
Well, the only thing I would
world?
say to that, I think that's all interesting. When we say that cap rates aren't tied to interest rates, I think the change, I still think they're more tied than not. I think the change is the transparency of the markets today. I think it's priced in. It's priced in. If interest rates had took 100 basis points drop, then I think cap rates would be coming in at a fast pace. But I think by and large, the interest rate reductions were what people expected. And so those, since they were forecasted out like that, and it happened as thought, I think those interest rates were priced in September. And if it had been different, I think you would have seen, and you would see change in cap rates based on that. But it did what everyone expected. So I think there's less big swings. I think the non-big swings, right, to me, aren't the end of the world, right? What were we talking about like 18 months ago? Like, we need certainty, there's volatility. Well, seemingly as it relates to that world, we're getting it. What they're saying is what's happening. And so it feels like whatever is happening, we kind of want the opposite, right? Like, it was the interest rates were like, what was going to happen? There was volatility. What are they going to do because of tariffs? And, is unemployment moving? And therefore, what's going on? Well, what they forecasted is what seems to be happening. And now, so isn't that the definition of more certainty in rates? And therefore, well, that's what you were craving. Like, what did I hear like 18 months ago from every investor out there, right? Well, if rates are high, we have a plan for that. If rates are low, we have a plan for that. We just need to know where they're going to be so that we can execute. Well, clearly you're getting a little bit more certainty of that. But now that it seems, well, let's not focus on that. Let's focus on something else, because maybe they were hoping for something that maybe it really wasn't certainty that they were looking for. Maybe they were hoping for an actual macroeconomic event that didn't happen.
Right. Or a quicker shift where there would be an arbitrage between interest rates and cap rates that would be meaningful or more interesting. I think that's part of it. But also the long end of the curve really hasn't moved much, right? So there's a big difference between the federal funds rate and the 10-year treasury. And I think if you don't have a lot of movement on the long end, then long-term financing is not really getting all that much more attractive, maybe a little bit. And so that's affecting the pricing on deals too.
Sure.
Not, often clients will think, if they're newer to the industry, oh, the Fed just cut 25 basis points. Let me call my lender. My rate's immediately going to go down 25 basis points or 50 basis points. And it doesn't always work.
Sure.
I would say it almost never works that way, actually. Yeah. So more consistency from the lender side, slightly improving liquidity and improving terms. But the discussion, like you said, is less about that, maybe because we have certainty. And now we're on to categorically, where do we see risk in retail?
I think the availability of the credit markets is robust and incredible, and that's going to help transaction volume, no doubt.
Yeah, for sure. And anything that gets the market moving, clears some inventory, and helps everyone execute their plan, whatever that plan might be, which are pretty varied, is definitely a good thing. So.
Yeah, I mean, banks sat on the sideline for a bit,
right.
Didn't put out as much money, and now they're putting out, dollars and want to put out dollars. And I think that always usually opens up the transactions.
Good. So I'm just going to take that and say 26 is going to be an amazing year.
There you go.
Investment sales brokers.
There you go.
That's the nugget for today. Fingers crossed. Okay, let's move on to the number 2, which is supply and demand. And we've been talking about this for a year, right? Vacancy is historically low. I think I've said now for 4 years. And it is still historically low, but it's more nuanced than that. So tell us what you're seeing and why that's interesting on supply and demand.
I met with what I would call a major retailer who is not in some unique size range, a brand that is pretty iconic, people love. And they told me they had 80 shopping centers in the United States that they identified that they wanted to be in. And they had more than 80, but of all the shopping centers that they identified they want to grow and be in, 80 of them have no availability for them. No vacant space for them to get into. And so to me, that was like an unbelievable headline that there was actually 8, because if it was 2010 and I can't imagine they could come up with a list of 80 shopping centers that there was zero vacancy that they wanted to be into. I'd met with a bunch of retailers, and when you synthesize the information, the average number to me was 50. That's the expansion plan, like 50 net new locations is like kind of on average, some a little higher, some a little lower, which to me was interesting because usually there's a disparity on mature retailers and growth retailers. And you have your exceptions of there's some, crazy hot food and beverage brand that wants to open up 250. And you have some, legacy mature brand that's only going to do 5. But in general, inside the bell curve, like the average was 50, which to me, and that spanned both growth and mature tenants. And to me, that was super interesting because there usually is a wide gap. And so what I took away from that was that's like the number that they feel comfortable announcing that they can execute on based on staffing, availability, and macro conditions, the ability to execute because of municipalities and all that. It seems to be like the number that most retailers of scale feel like they can execute is around 50. No doubt if they felt they could do more and the space was available and execution was simple, then, that 80 that one retailer wanted to open into, they would do it. It's not a lack of capital. So I think that speaks more to the supply constraint than just openings are higher than closures and occupancy is up. What does that really mean? And, dovetail to when you start talking about individual businesses. And we seemingly right now, it seems the consistent number that people feel they can execute on in America's 50 net new locations. So we'll see what happens, but that's what my takeaway from the supply and demand world.
I wonder how many locations they would like to be in, but they don't want to publicly say. And we'll never know this because this is, internal conversations. But I wonder if it's like we have 150 locations we love, but we think we can only get 80 done or 50 done. So we don't want to announce more and fall short.
Well, a lot of companies do announce like what they believe maturity is for the chain. And they say how many, locations can the country support for them. And then you break that down on an annual basis and you can see how many years of runway they still have before either they come up with a new concept, the concept changes or something like that. So they do, you can back of the napkin it based on, that, because most of them do announce like how big can the chain be and still maintain, the AUVs that they're.
I feel like that changes though, right? Because retailers will adjust strategy, go into more rural markets that we never thought they'd go into, or change a new prototype.
Within a 5-year period, it doesn't change that much.
Okay. So you're saying short term versus long term.
Yeah, within a 5-year period, that number kind of stays consistent. I think what changes about it is what happens as they open.
Okay.
Which we'll talk about in my next.
You're cut off.
My next theme.
You can't skip ahead and go to the next point. All right, we're going to move right on before you give away too much. The third point is a conversation that I had, which is an amazing demand for value net lease. Now, this is interesting because not that long ago, let's call it 4 years ago, 5 years ago, value net lease, which we define as anything that's short remaining lease term, below market rent, maybe no options. Years ago, again, not that many years ago, that would have been very difficult to sell because it's an unknown, it's risk, and net lease is designed to be stable, long-term cash flow. Now, because new construction is so limited, very, very limited, value net lease or short-term net lease, below market rent net lease is incredibly in demand. And this is all of your professional buyers, your developers, even just, savvy private clients who want to get something at a slightly higher yield and then know that they can backfill it, or they're willing to go through the leasing process. So instead of being sort of an afterthought on how are we going to move this 3-year QSR deal, now it's like, oh, this is great. We have a 3-year QSR deal and the rent's only $90,000 a year. This is amazing. This is going to fly off the shelves. So I think that's been a big shift, which goes back to what you were talking about, which is lack of availability. It's just kind of showing its face in a different way, with repositioning being the new hot item.
I've always loved that asset class, call it value add net lease. For us, generally speaking, unless it's at scale or a development deal that we're working on for a preferred client, it's not the core of what we're chasing because it's too small. But personally, of an asset class, I love that asset class because what you're really saying in that scenario is we're not coupon clipping and buying the credit of the tenant. What we're doing is we're focusing and we're buying great real estate. And when you buy great real estate, opportunities unveil itself. The dislocation in the pricing there and the value is because that property might be transitioning, but the fundamental dirt underneath is still fantastic. That then it comes down to, do you have the skill sets, you mentioned professional buyers, to actually extract that value and execute on a business plan? It's hard to scale that from, like where I sit in the job that I do every day. It's hard to scale that. But from an asset class, I think it's super compelling. And I think it's a really interesting asset class. I think the opportunities are more scarce than some would like to believe in that.
Definitely.
But primarily because if you were the buyer who bought something that's in distress today, like, you're going to have to take a loss if you sell it to someone else to give them the opportunity to add value to. So that unwinding typically doesn't happen overnight. And
I'll just add, sometimes you need capital to make more capital,
you need,
right?
No, most times those are going to require, in my opinion, capital.
Right. Unless it's a straight ground lease and, obviously the site's already pretty built out, but
yeah, if you want to buy a short-term lease and you have a relationship with the tenant, and then you're going to create value by compressing cap rate because you get term. I mean, sure, it's hard to do. It's hard to find.
That's not exactly what I was talking about. But the blend and extend's been around forever.
Right. Hard to find. I think the reality is that most of them will require capital. Some of them might require knocking that building down, getting a new site plan approved. And, you know, what you end up getting to, in my opinion, is where the real value in that is like, it's a new development. It ends up being a development deal. I think using just the existing site plan of a vacant, you know, pad box and re-tenanting it accretively, which means you're going to get a new tenant with maybe equal or better credit at a higher rent, and then the cost to re-tenant it is worth it based on the rent. Those opportunities are scarce. Are they out there? Sure. They're scarce, right? And making it so they'll take the existing four walls that are there, so you don't need to go for a site plan approval and get entitlements. It's, yes, that sounds good on paper, and that's why I said I love that asset class, but I get to see and get the opportunity to see a lot of deals. I can tell you I don't see a lot of those opportunities out there. It's
very difficult and a ton of buyer demand, like I said, and not a lot of product. You have to really know the markets. You have to know what tenants would backfill. You have to know at what rates. You have to find these opportunities with short-term leases, which may or may not be on the market. But like you said, when it works, it's great. We just did one that was a Bojangles that went dark, and Bank of America took over the site. New, fresh lease. They put in a ton of TI because they really wanted the site, and the rent was higher. So credit upgrade, more NOI, new, fresh lease. I mean, it was a huge win for the client. When they first called me and said that the Bojangles is vacating and we're panicking, I'm like, this is a great location. We'll figure it out. And now, of course, they're thrilled. But it's not always that easy. But when it works, it's great. We have also had a lot of conversations with clients buying dark Rite Aids and all of the creativity around that in the repositioning. And to your point, if they get them at a low enough basis, some are just knocking them down, because in a lot of cases, that's a 2-acre parcel and you could put a Wawa on it. You can put a really strong tenant that's paying high rent, but that requires capital to work through the next phase of the redevelopment.
I can tell you, we looked at the Rite Aid list because that was something at scale. Mm-hmm. And for those who don't know, the Rite Aid list, they filed, they're going to sell off their assets and their physical assets in the bankruptcy court. And I looked at a list of 50, mm-hmm. and what we would have to pay to buy those in bankruptcy, which you would think you would get a steal. And then knowing what in those markets, what we thought we could get in rent, who the tenants might be, and the cost, we couldn't make the numbers work on a lot of them. Like on a one-off basis, you could,
right? But
like on some, but to buy them at scale, it was turning into an exercise that really wasn't that fruitful to go through.
And I think that's your position where you're coming from, right? Yeah. You buy typically very large assets with a lot of re-tenanting opportunities. This is a roll your sleeves up and really get in there and dive in, spend a lot of time per asset. So I could see where it wouldn't make sense for larger landlords, but your smaller professional clients, some, like I said, savvy private clients or small teams have had some success. But
I think there's success out there. Yeah. That's not what I was saying. My point was just that it is harder to find than we would like to believe.
Which is why they're booking endless broker meetings and telling us all the same thing. We want this, go find it. And I'm like, okay, you and everybody else. But it's certainly a hot item right now.
Got it.
All right, let's move on to the next one, which is retail is performing exceptionally well at the store level. So this is your conversation. How do you quantify that, and why do you think that is?
More specifically, what I was saying, and I said I don't want to get into the theme just yet, is new stores are performing. And so one of the things, right, we went through this period of time where there was a lot of new stores, right? What took occupancy up so many points was because we leased all these spaces in America and all these new stores opened. Well, those stores are performing. And despite macroeconomic conditions, retailers are super convicted about new store growth and continuing. I mentioned the number is 50. Everyone's going to open up 50 new stores, whether it's a franchise, a public, a non-public, like that was the average number. And so when I think about that, and I think about they're convicted because of their new store performance, right? It's one thing to have like a legacy portfolio and you've been there forever and the customer in the market knows where you are. But the fact that new stores are opening and they're performing despite macroeconomic conditions of uncertainty and what they're saying about, what will be, I think that that's super refreshing and that's giving retailers conviction. I met with like no retailers who said, and I had meetings every half hour for 2 full days plus dinners and whatnot. No one said they weren't opening stores. No one said, in general, everyone's opening way more than they're projecting to close. And to me, that's refreshing. And one of the things that I hadn't heard before so much, prevailing theme is that our new stores are performing so well. I think a lot of that relates to like the data they have to be able to site select, the experience, really knowing their customer, knowing the markets they should be in, the type of product that works for them. All that's coming to fruition now and yielding real results in the form of new stores are performing really well.
What is the KPI that they're judging? Are we talking about sales tied to the location? Is this impressions? Is it foot traffic?
So it's right now it's sales. So
it's just sales per square foot.
It's when we got this deal approved in committee, we said it was going to do X sales.
Okay.
And it's opened. And after year 1 or 2, it's doing Y sales. And Y sales is at or better than we perform it.
Okay, that's crystal clear.
Yes.
Because a lot of our discussions have been, the store is the billboard, the brand, the touch point, which is all real and important, but much
way
harder
better
to quantify.
than that.
So this is real sales per new location. And you think part of the driver of that is because the data that they have to select the stores is continuing to improve and increase. And so they're just finding better and better fits for the brand over time?
I mean, that's part of it, right? There's a lot that goes into why that's happening.
Mm-hmm.
Obviously, they're getting tailwinds of positive macroeconomic drivers. Unemployment's low. People are spending, whether they should be or not. The reality is people are spending. And so you have that tailwind that always helps. I think there's no doubt that I go to a lot of meetings and people have been in the business a while. They have experience. They know what works. These businesses have spent a lot of time figuring out what works for them and dialed that in. And you have data that you probably didn't have 15 years ago about your customer, about site-specific things that work for you, what doesn't work for you. And if you just look, right, of what's working, I think you're going to see the watch list of tenants and bankruptcies for 2026 is significantly less than it was, right? There's no major alarm bells. And I think that's partly because of the store performance.
Nice. I saw something, this is tangentially related, but I have to bring it up, that there is legislation out to limit dynamic pricing online. So dynamic pricing would be like you and I would be charged different amounts for the same item based on the data the retailer had on our consumer profile, right? And as soon as I heard that, I was like, I should just go into the store. That's annoying, right? I don't want to be charged a theoretically higher price than somebody else. And I'm sure that's not driving a lot of consumer behavior, but that was my first thought this morning when I read that. It was a New York article the store is just way more straightforward.
It's fascinating to me that that's come up. I mean, there's so many other dynamic pricing business lines that feel like, I guess what they're using to come up with the dynamic pricing is what it sounds like. But I mean, airlines have done this forever, right? Like the price changes. You can go on and the price of the seat is X. And the moment that flight starts filling up, well, then it's going to be Y and you're in trouble. So I'm shocked that that's the one they're going after. Maybe it's because of the data they're using.
Right.
For
and
the
again,
dynamic
with the
pricing.
airline, that's supply demand. I think the dynamic pricing with retail is just consumer profile. They'll estimate what they think you will pay based on your past purchasing behavior and then charge you that, which could be more than someone else, even if there's been very low sales for that particular item. So it's not supply demand driven.
So interesting. profile
driven.
I get it. I'm like, I didn't see that. But
I'll send it to you.
I'm walking through like
what they would be basing it on, and right.
And like just that's so interesting. And less about the retailers, like more about like the legislation and that this is something they're going after. That's super interesting.
To be continued.
Yeah.
I'll send you the article. So my next one was credit and term is in focus, but very hard to find. So what I mean by that is credit of the tenant, so investment grade credit or very strong private credit companies with long-term leases. So we used to have plenty of tenants that were expanding. Think drugstores, it's an easy example, with investment grade credit. And they would sign 20, 25-year base term leases with another 50 years of options. So very long-term deals. They're not expanding, and there are less tenants that are able to build ground up with long-term leases. So there are not as many investments that offer the same term and credit profile in net lease. So because of that, the more institutional clients are pushing more towards sale leasebacks, where you can design the lease and work directly with a tenant, make all the terms work. But there's not a ton of credit there either. So I think the focus on maintaining WALT, weighted average lease term, for those of you listening who don't use that frequently, to maintain a high WALT in a portfolio is getting much harder. So we had a lot of discussions with, I really like XYZ deal or this small, portfolio of deals, but it's going to bring my WALT down to X and I need to keep it at Y. So if you can find me something else that has 15 plus years, then I can look at these 8-year deals. But we just don't have enough that's long term. And so I don't know what the answer is there. I mean, I think construction is going to remain constrained, and we don't have a lot of new tenants willing to sign those longer terms. Overall, the base terms have pulled back, but that's going to, I think in the short term, increase pricing for anything that is credit with a long term that comes out.
Got it. Okay.
That's it?
That's all
so
I got.
That's your whole response, Scott? I don't think you've ever just said, got it.
I got it. I
mean, I agree. Done.
I think I'm not, I think
not your space day to day, so it's fair.
No, I would just say I think that's driven just much more based on the fact that there's less new construction.
For sure.
Than retailers willing to agree to long term. Because I'm seeing retailers both in freestanding, net lease, and everywhere sign up for long term. But yeah, traditionally a 20-year term, a 15 plus, it typically happens on new construction or the first lease versus the renewal or whatnot. And therefore, I could see that being a challenge where, since there's less of that, there's less of those leases out on the market. But just in general, I'm seeing, retailers want to lock up what I'll use, it depends on your definition of longer term leases at fixed rates at scale. I'm seeing that. Now, longer term is definitely eye of the beholder, right? If 10 years doesn't mean long, okay, fair enough. I think 10 years is decently long. For a new construction, for some deals, maybe not. But for a lease renewal, I think that's pretty long. But if that's not enough, 8, 10 years, and you need 15, 20 to make it work, yeah, I don't see those every day, sure.
I mean, there's certain types of financing that are predicated on those very long-term deals.
Yeah.
CTL, we used to do a lot of, because the financing matches the lease term, and they really will only look at deals here, primarily that are over 15 years. So there's just not a lot of that product. And we're seeing the backfill locations, even if it's a new location for the retailer, they're still offering a shorter term than a new build to suit, because I guess they can, right? They have more leverage in that situation if they're backfilling than if they're working with a developer on
ground up
build to suit, right?
Sure.
So definitely a shift in what's available, and it's making some institutions kind of have to rethink their metrics for their investors, which is tricky.
Got it.
All right, let's go to your last one, which is retailers are investing in their stores. This is good news for retail landlords. Tell us
I
the
think
good news.
There's a lot of retailers that are, whether it's a remodel, new fixtures, new products, reinvesting in their stores. And this is a consistent theme I heard, or that's the plan to do. And I think this is exciting, right? In 2010 to 2020, a lot of the capital at any of those companies went toward digital e-commerce. That narrative has waned, right? It's not about the clicks. It's you can't make money in the clicks without the bricks, and the in-store experience is so important to these retailers now. And so I think you're going to see a lot of remodels. You're going to see fresher stores. You're going to see new products in stores and reconfiguration based on those. So a lot of investing going into the store, which I think is a great thing, right? When they want to make the stores better, that's going to be better for the shopping center, better for the experience, better to curate additional tenants, right? It's a good thing when you're marketing to a tenant and you can say 3 of the tenants in our center just remodeled their store.
For sure. Now, are they asking the landlord for contributions in a lot of these cases? Or
I would say a majority, no.
Oh, that's even better.
Majority, no.
Right.
They're not lease action based. They're, even some smaller things, right? If you're like Michael's Arts and Crafts and you're going to bring balloons and take on the party business, and which they've done pretty well. Well, your store wasn't built for that. Now you have to remodel to like create the opportunity for party to be in the store. And I think things like that are great investments into shopping centers.
I hope they can also solve the labor piece. That's my personal frustration when going into a store. If there's not enough people working there or they're not trained, I think that impacts the store experience. So I'm hoping with the new remodels and money they're putting into the stores that can be a little smoother as well.
I had fewer conversations about labor and AI than I thought I would.
Okay.
I don't know if you talked about AI a lot in your meetings.
I actually talked about AI zero over this week.
Isn't that fascinating?
It is.
I didn't either. It's like the hottest topic. Every conference I've been to over the last 18 months, which is a lot of conferences, AI was the dominant storyline.
Right.
And
it just didn't come up. And I actually didn't even realize that until you said it.
It didn't come up at all, which I was fascinated about.
Interesting. And I mean, labor isn't normally part of my investor conversations, but I think in meeting with the retailers, I would have expected they would have still.
It normally is, right? Like there's a lot of pressure on labor. It really didn't come up.
Okay.
No one said like they're having trouble staffing the stores for holidays. We hear that.
That's great.
Times, none of that stuff. And, and I thought I might have heard like, oh, we're having trouble hiring so we're working on this AI initiative to try to help. I heard AI very little.
Interesting.
Same with you though, right?
Oh, no, for sure. Not at all. I wonder if people are just tired of talking about it. It's like a burnout. We're like, all right, we're just going to take a break from this for a little bit.
Maybe that's what it was. But like both of us in our conferences before this, it was the dominant conversation.
Yeah. I mean, from our end, it was what tools are you using? Here's how I'm sourcing deals. Here's how I'm looking at markets. And now it's just, it wasn't a conversation.
Yeah.
Interesting. All right. We'll have to do an AI update like next spring and see if that's still the case. But right now we got a break. Which was good.
It's not going anywhere. That's not us saying AI is going anywhere, everybody. I'm not saying I use AI every day for
you're good.
A lot of what I'm doing. And so it's not that it's going anywhere. It's just surprising that it wasn't a dominant conversation piece.
Right. So it's nice to hear that they're focused more on investing in the stores and improving the shopper experience and probably the layout of goods and just the overall feel. Because I mean, I'm sure as a landlord, that is like beautiful music to your ears that your centers are going to keep improving and not at your dime.
Yeah.
Love it. Well, I think that covers our themes for New York ICSC this year. We do expect these are going to carry into 26. So this is really the start of the conversation instead of the end of the conference, which I always like these takeaways to see what we can look forward to as well as what we've just discussed.
Awesome.
To everyone listening, that was this episode of What's in Store with Carly and Chris. We're so happy you tuned in and we look forward to seeing you again very soon. Have a great day, everyone. Thanks, Chris.
Thank you. Bye-bye.